Neeraj Deewan also joins us on the show. Neeraj, hi, good morning. Thank you so much for making time and speaking with us. Your take as far as CanFin Home is concerned, do you think the leadership change with Mr. Aiyar coming on board is likely to change the fate of the company going forward?
Yeah, good morning. Actually, yes, because the bank, the company CanFin Homes had been under pressure earlier. When there was a sudden exit of the top management. I think after that, though valuations have been still attractive, but we did see that kind of a rally. Though from the bottom it's come up and it's been consolidating around these levels of 500, 550. But I think based on valuation and the kind of business growth that we've seen there, and which it has been seen over last so many quarters. I think there can be some re-rating here from these levels. Though it will definitely depend on market behaves in the shorter term. But if you value it at least 1 year forward, I think the target of 630, 650 is what our analysts have attributed to CanFin Home. So I think definitely there can be some positive momentum if one is a long-term investor for a 1 year period.
That's the take coming in on CanFin Homes. Meantime, Neeraj, also curious as to how you're reading into Reliance Industries as a stock, given that of late we've seen that choppiness as well as volatility. From the fundamental standpoint, do you believe that there are likely to be potential triggers on the upside and this phase of consolidation may be behind us now?
Yeah, actually, you've seen Reliance had been between the 2200, 2700 band for quite some time. Now it's come closer to the lower end of the band. And there are definitely positive triggers which will come later. Maybe it's the listing of Geo, or it can be the retail arm getting demerged into a different company. All those triggers will come eventually. So valuation wise, definitely, after the correction, it looks more attractive. It is just, I think, because the way market is behaving, a lot of people have been waiting for these triggers to happen, have not happened. So maybe it's a short-term fall that we've seen in Reliance. But I think triggers are definitely going to happen going forward. And if one is looking at a longer term of 2 to 3 years, then definitely these kind of falls are opportunities for long-term investors.
Okay, that's the view coming in on Reliance Industries. 22-23 is where the stock wrapped up Friday's trading session. But let's shift focus then to the consumer durable space. That's seeing a demand slowdown. And my colleague Vinny joins in with all the key takeaways from the BNK Securities report and what to make of the slump. Vinny.
Absolutely. What BNK Securities done, they've done a channel check with distributors and dealers. And now the first sign in terms of ACs, it's summer season, we should be expecting good demand, but there's a slight delay in demand in terms of the pickup that we're seeing coming in for the room AC segments as well. Though they're saying that the inquiry pipeline seems to be strong. So yes, from the second half of March, we could start seeing a better pickup coming in is what the indication is coming in. They're confident that there'll be a good demand pickup in the second half of March. Now, other than that, they're expecting a volume growth at least of 15 to 20% versus the last summer season, that's summer 2022. So summer 2023 will still see a growth despite that slowdown and a slight delay in terms of the pickup of demand. Overall, the dealers and distributors are also witnessing some supply challenges. So that's a factor that we should keep an eye out on. And some of the brands have taken a price hike of around 1,200 to 1,500 rupees in the last couple of months. So keep an eye out on that. Moving on, the fans demand, let's not forget, the BE rating has come into play. There was some inventory of non-star rated fans as well. So the demand as of now is, more for the non-star rated. But yes, star rated also we are seeing an increase coming in terms of demand there as well. It is going to start seeing an improvement. And obviously the price difference they are indicating is very negligible in terms of both these fans, the non-star rated and the star rated fans. So not much of an issue there. But yes, demand pickup for fans is also similar to ACs. A bit of a slowdown in terms of demand there, but expecting to see a pickup from the second half of March. Other than that, in terms of other white goods, refrigerators, the products have seen a muted demand in terms of the pickup there. They're starting to see a recovery again in the month of March, second half of March. And price increases are also taken in the refrigerator segment in terms of 5 to 6% increase in terms of the prices, and could expect a further increase in terms of prices in the month of April as well. Washing machine are seeing a stable demand as of now, and expect a 8 to 9% growth over there is what BNK Securities is suggesting. TVs, the demand has remained remained weak as they are facing stiff competition. Other than that, brands like LG, Voltas, Dakin, Blue Star are leading the summer season as well, with Lloyd's obviously being among the top leaders. Refrigerators is also seeing a good demand, while Whirlpool is losing some market share on a year-on-year basis. So we'll be keeping an eye out on Whirlpool's market share as well. And LG and Samsung, I beg your pardon, are leading the refrigerator growth, where washing machines also are seeing a good growth in terms of the market share for them as well. So both LG and Samsung together hold market share of around 45% in refrigerators and washing machines as of now.
Thanks very much, Vinny, giving us those highlights there. Expecting summer growth this time around, volume growth to be in the range of 15 to 20%. Meantime, Neeraj, let's get in your thoughts then on some stocks in trade. And what's the outlook within the mid-cap space on the Nifty 500? Incidentally, you did have some stocks that did manage to hold out quite well. JK Paper, a solid 10% nearly, and KPIT Tech as well soared high. Views on the charts?
So JK Paper has formed a base around 350 levels. Yesterday, I think some of the impact could have been from the ETF rebalance. But technically, the stock has been range bound. 350 on the lower end is the support, 450 is the upper band of the stock. And it's been holding on to this band for quite some time. So still, I would expect some bit of a fade off today. If it comes closer to 365, that would be a buy with a stop loss at 350. Has been the best performing paper stock over the last 2 years. So JK Paper looks interesting again for a bounce towards 400 to 450 levels. KPIT Cummins on the other hand has been the best performing mid-cap, small-cap IT name. The stock is very close to an all-time high. Again, a little bit of a volumes could be from ETF, but the trend is very clear. Higher tops, higher bottoms continue. A little bit of a fade off towards 840 today could be a buying opportunity.
The take coming in on a couple of these counters, JK Paper and KPIT Tech. But Kunal, it's the auto index which has been on the back foot of late. In fact, 7 weeks on the trot, we have been seeing that that entire space has not really done much. Do you think that's going to be the trend, at least in the near term, auto stocks in the reverse gear?
Yeah, they are into a reverse gear, and I think dominant reasons for that, Anisha, is because the likes of M&M, Maruti, which were two, I would say, good performers for 2022 second half and in the first 1 or 2 months of 2023. These stocks have gone through a very sharp correction. In fact, M&M has, I think, corrected more than 20% from its previous highs of, I think, 1380, 1400 plus levels. Now the stock is at 1100 and below. Maruti Suzuki has corrected from approximately 9,200, 300 levels to 8,300. Tata Motors is also not finding any major kind of a recovery, breaking past about the 450 levels convincingly. So most of these large cap auto names, which are actually doing pretty well in the second half of 2022, these stocks have gone to a correction, and I think that's why the sector is underperforming. The charts for M&M as well as Maruti are still not indicative that these stocks have come anywhere closer to their oversold territory, which means that there could be more selling pressure at least for the next couple of days. Until the time we don't see some oversold nature of indicators on these charts, it's going to be difficult to expect that auto stocks would get into a steady recovery or an immediate recovery from here on. So I would probably wait and watch on these auto stocks. But yes, if these names come back into oversold territory, then we may expect a reasonable bounce into this space as well.
So a bit of wait and watch when it comes to the auto index. But Neeraj, what about the entire IT space? There was a bit of a hint of a recovery at the start of the year, and we thought maybe this year is going to be better. But now with this entire BFSI, Armageddon playing out for the markets, do you think it's probably the time to stay away, wait and watch as far as IT stocks is concerned as well?
Yeah, actually, the kind of correction we've seen in IT stocks, even if you name, the large cap stocks like Infosys, has been massive. We saw Infosys coming to 1400 around levels last year also, when there was a talk of this, interest rates going up, inflation picking up, slowdown in growth, from US. So, it's again come down to those kind of level, after bouncing back. So definitely there's a concern in the shorter term. So one needs to wait and watch what the situation unfolds. One, there can be some issues with the BFSI clients, which some of them have, especially the large cap IT names, which have exposure to US BFSI space, Europe BFSI space. So there can be some small pressures here and there for them. So right now also there's no clarity in what kind of slowdown, if it comes, we can see in US. So I think one needs to wait and watch. Though valuation wise, Infosys below 1400 looks attractive. Then again, if one is a very long-term investor, these are companies which have solid business models. They have done very well in adverse of times, and they've recovered very fast from the lows that they've seen in business cycles. So that those are all positives for the sector. So one needs to wait and watch, and definitely look at entry at lower levels. So the large cap IT names should be under your radar, and even the mid cap IT. We've seen some good companies which have corrected and still not been able to come back. So there also one can look at opportunities, but I think it's still a wait and watch for now. Let's see how the situation, which is still evolving, pans out in the shorter term.
All right, stay on with us. Let's move right on then and take a look at the management takeaways from Indian Bank. They've guided for a 13 to 14% credit growth in FY23, predicting that NPA ratios will trend downwards. My colleague Harsh joins in with all those updates. Harsh?
Well, yes, we're looking at 13 to 14%, while the banking system in general is looking at 15+% credit growth in FY23. So they're guiding for a slightly slower growth, but what they're saying is they're not going to compromise on margins. So the margin, in fact, was at 3.7% in Q3, slightly elevated on the back of some one-offs, but at the same time, it's a very solid margin, and what they're expecting is that trend to continue. They're expecting 3+%, well above 3+% margins going forward, and what they're believing is that their RAM portfolio and growth there will support those margins going forward. With regard to CASA, of course, deposit book is under the scanner at the moment for pretty much all banks, and what Indian Bank seems to be suggesting is that there's a cannibalization with regard to term deposits from the CASA, and they are also saying that there's a lot of intense competition from alternative investments as well. What they are suggesting is the cost of funds, which is currently at 4.3%, the incremental cost of funds is going at 6%, largely on the back of TDs and the shift to TDs, and they believe that building a new CASA book, starting something afresh, is a better approach, and they're trying to optimize the existing branches with regard to CASA as well. With regard to NPA ratios, they believe that that will continue to trend down. There's a bit of a relapse from the restructured book, and that relapse is going to be lower incrementally going forward. The overall slippages for FY23 is going to be sub 2%, and they believe that that is expected to sustain. Agri slippages remain volatile, but management believes that the recovery rate is far better now, and they believe and they're positive largely on the back of the fact that 53% of agri loans are backed by collateral. The bank is also one of the key beneficiaries with regard to the resolution mechanism that's working out in the system. Sri Infra, ILFS are some of the exposures they have. MK continues to retain a buy. They believe ROAs will reach 1% from 0.8% predicted in FY23, and target price of 375 is what they've given, which is a solid 35% plus upside.
Okay, so that's the takeaway coming in from the Indian bank management meet, a bit lower in terms of the credit growth versus the rest of the peers and the industry at the moment. Neeraj, but we were earlier speaking about Godrej Consumer, and there was a fresh note that was written by Goldman Sachs as well, and they are talking about how perhaps the worst of the pain period is over for the company and turnaround is expected to gather momentum. Is there any FMCG name that looks very attractive to you at this point of time, and a word on Godrej Consumer specifically?
Yeah, actually, there was a news item also which was there last week regarding rural spend. There's some improvement in rural consumption, so that may also help some of the consumer names. But when you look across, though, they may be defensive right now because like you rightly said, some pain may be over for them, and rural demand is also picking up. But then valuation-wise, you don't find them that attractive. So they already be trading at 45, 50, 55 times on a forward. So that valuation comfort doesn't come. But definitely they can be treated as a defensive right now, and you can harden them till market choppiness, market volatility gets over. Still again and again that one name, this ITC, comes back because valuation-wise, ITC is still attractive. Their food business, the non-cigarette business, is also showing good traction. So I think that is one name which still comes in that category where valuation comfort is also there. So we've seen some correction also happening there. So that can be one name which can be looked at.
All right. What about, Neeraj, some of your top recommendations or picks from the mid-cap space? What is it that you would look at?
So basically, looking at more to do with companies which are into infrastructure, capital good, engineering kind of space. So there are and even domestic consumption. So like L&T among the infrastructure space has been doing quite well. And in last quarter, you see execution picking up also. Order books are very good, whether it's L&T, like you flashed NCC also, there also order books are very good. But among the other companies, we've been bullish on Kalpatru Power. JMC's merge into it, so it's become a bigger company. So that can continue doing well. Some of the companies which are into water and related space, like Ion Exchange, they are doing well, and they've also corrected from the high of 3,500 odd that they saw. We've already seen 10 to 12% correction in those companies. And even in the pump space, Kirloskar Brothers is one company which we like. The company have been doing well. Their margins are also picking up. Their volumes also picking up. So there also that valuation comfort is there. So these are the kind of companies. So even domestic banks, whether it's PSU banks, the larger 3-4 names, or the top banks like HDFC Bank, ICICI Bank. So these are, though there's this evolving situation globally, which can impact the banking space in the shorter term, may not impact, but at least one view is there that our banking space is in a much better position. So once this volatility is over, there also you can see a sharp up move coming back in most of these banks which have corrected because of the global financial problem that we're facing in US and Europe.
And since we're talking about banks, Naresh, your take as far as HDFC twins are concerned, because there was that news flow as well that the merger has now got a thumbs up from NCLT as well. Do you think that could result in some sort of momentum build up on both of those counters?
So could be a case wherein the stock eventually gets a re-rating. The stock has gone nowhere. So if you look at HDFC Bank, the stock is lower than the price it was in January 2021. So more than 2 years of a zero return, where a lot of banks have relatively done better. The last time we saw a spike was somewhere closer to November, when we saw a possible, say, merger-related tick, wherein the stock went from 1530 to 1630 levels. And then we continued towards 1700. We came back to 1530 couple of days back. So at these prices, the risk reward is good if one wants to play out for that re-rating once the whole merger thing goes off. And I would expect that eventually the stock goes to 1700. But the bigger trend starts when it starts crossing 1700. So at current levels, positive on HDFC Bank as well as HDFC Limited.
Okay, meantime, Neeraj, wanted to get in your take as well on what the outlook is on some of these consumer durable stocks. Just a short while ago, we were talking about that BNK report, which says that demand for fans has not picked up. Volume growth is expected in the range of 15 to 20%. What is your expectation for the upcoming summer season?
What we've seen earlier also, demand for ACs or fans or refrigerators, which are mostly linked to summer season, it picks up later, because right now also I'm from North, so it has not become that hot right now. So basically, second half, towards beginning of April or end of March is when it starts getting hotter, and that is when the demand really picks up. You get a certain spike coming in just a couple of weeks when you see really temperature soaring. So that I think will come, because I think demand for refrigerators, ACs specifically, coolers will pick up a little later. So there can be a spike there. So the companies which are into most of these products, which are refrigerators, ACs or fans and coolers, should benefit. I think there will be that volume pickup, but I think that is yet to come.
Okay, so that's the take coming in as far as how the channel checks are, talking about the AC companies and how one should look at investing into some of those counters as well. But Naresh, I wanted to come back to the point that we were speaking about the IT companies. The last 10 days were quite eventful with the entire leadership change happening at Tech Mahindra as well as TCS, and now very soon we'll be at the helm of the earnings season as well. Is there any near-term trade that you would like to play when it comes to the IT counters?
So in terms of IT, there's a different view on every stock as such, because every stock is in a different trend. In mid-caps, there are some stocks at a 52-week high and some at a 52-week low. So my picks out here right now in the large cap is, say, Infosys again looks interesting. The stock has corrected back to that 1400 mark, 1400, 1420. It had gone up to 1650 levels. And now we are back to the 1400 price, which is important because the low in May and September also was closer to 1350, 1370. So this could be a bounce back trade. Then in terms of a leadership shift, it is Tech Mahindra even in terms of price action. So if you look at the price action, the stock has sustained well over the last 2 weeks and is setting up for a fresh breakout above the 1150 to 1200 mark, which was the high in September. So once this happens, this could be a stock which would go towards 1400. So this would be the picks in the large caps. Then in mid caps, small caps, it's a tough call because the ones you like have already gone up quite a bit, something like a KPIT, Tech, etc. So waiting for a little dip in the mid cap, small cap IT space to start participating. But as of now, Infosys and Tech Mahindra look interesting.
Okay, fair enough. That's a view coming in on the IT space. A quick look at the pre-open rates, and given what the SGX Nifty has indicated, it's no surprises to see a cut. For now, it's mild on the Nifty, about 0.33%, and for the Sensex, off by about 78 odd points. But let's get those mid-cap ideas going as well. And Kunal, what are you tracking?
So it's a buy on NCC, the stock looking quite attractive on the charts. We flagged off the stock earlier at closer to 94, 96 levels when the stock was heading towards a breakout above multiple resistance as well as a swing high on the monthly chart. So that breakout is confirmed. The stock is trading above the 100 levels. So would suggest a buy with the target now at 112, stop loss at 98.
Suresh, what about you? What's your top mid-cap recommendation?
So that would be a contraband Bharat Electronics, BEL. The stock has drifted from 115 levels back in September towards 1994. The last bottom for the stock was around 86 odd levels, which was the last breakout point also. The stock is in a downward channel and which could eventually break out above the 9800 mark. So at current levels, the stock looks interesting in terms of risk reward. And I expect it to eventually break out and take a move. And we are seeing the whole PSE pack do well one by one. And the next one, which looks the best in terms of risk reward, is Bharat Electronics. I would expect it to eventually cross into an all-time high as well. And it has been one of the best performing stocks in the PSE space in every cycle. So I expect this to be in the, say, reckoning of a breakout going forward. So preempting that whole move makes a risk reward very interesting. A stop loss at 88 and an initial target price of 110.
All right, let's move right on then and focus in on the khabar on Dalal Street. Divi's Laboratories has held an analyst meet recently, and the management says that the cost pressures are easing across major and due to major factors. My colleague Pankaj joins in with all that khabar. Pankaj.
So Motilal Oswal, Securities met the management at Divi's and they came out with positive takeaways. Firstly, regarding cost, remember margins has been one of the key concerns as far as Divi's go, and that's why this is particularly quite important that cost pressures are actually easing. Now they have been doing ongoing capex, and they believe that is something which will continue to aid their growth, whether it's gaining of market share, gaining of volume share in existing products. All of this will be important triggers. They believe that they continue to have a moat versus rest of the other API and other supply providers to many companies, and that's one of the key reasons why they are optimistic and they are investing into new facilities. Overall, after the correction, Motilal maintains its neutral, but the overall takeaways from the meeting seems to be on the positive side.